Not a whole lot of people like those financial surprises where the IRS puts out their hand and says, hey, you owe me X amount of dollars in taxes.
Right.
And so part of our process, year-end process, is doing a tax projection for the current year.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome into Your Life, Your Money, a podcast that's helping you thrive in life, wealth, and retirement. I'm Ben George. He's Scott Searens, the president and financial advisor over at Searens Financial Group, serving primarily the Chicagoland suburbs. You'll find his office there as well, but we'll find everything online. We put everything we work on. Scott's doing stuff every single week, working to create new content for you to help educate you and in all areas, finance, and all that can be found at lifemoneyshow.com. And today, Scott, I know it's we're recording this in September. It's not going to post till early October. So whenever you find this, kind of a little sense of when we recorded it. But we're talking end of year planning strategies, tax planning strategies. You might say, well, why are we starting this so early, right?
Yeah, I know, coming across the airwaves that people could be like, wait a second, like we're not even to December yet, right? It's like you start to see that the Christmas decorations out when it's, Halloween just ends. But I think it's a great time. Now is the best time to really start planning and preparing for this, because waiting till the end of the year, next thing you know, you're like, oh, wait a second, you didn't carve off the time or enough time. And strategies, tax planning strategies that you could put into place, right, to really help you, your situation, help keep more of your hard-earned money with you versus giving it to the IRS. And then you just didn't save enough time. The cutoffs have gone by, and you weren't able to do it this year. So one of the processes, part of our planning process with all of our clients is October. The month of October, September, October is our year-end planning and tax strategy sessions that we go through. And I look forward to talking about a lot of the different categories today that we go through with all of our clients.
Good. Well, that's going to be, I think, a very valuable conversation for a lot of people, even if you're listening to this and if you find this episode in January or February, at least listening through it, give you some things to think about for later in the year. So whenever you hear this, it's always good to be kind of taking some notes and keeping this in mind for when October, November rolls around, you can actually execute. I want to kick things off with a little quote to give us a little inspiration as we get into today's podcast. And this came from an unknown source, so we're not sure where this quote, who first said this, but it applies so well. Retirement is wonderful if you have two essentials: much to live on and much to live for. I think it's so true.
I agree. Maybe you kind of hear sometimes people talking about, right, that people could have a ton of money, but they're miserable because they really don't have a purpose. They don't have things that they like to do, activities that they like to do, vacations that they like to take, or just a reason for what they want to do each and every day. However, you could have all of those plans of all of these things that you want to do, but if you don't have the funds to be able to fund it, then that can make things really tough as well, right? I'd really suggest for people to go back to it was episode 15 when we talked about what is your money for. I think a lot of times folks can get so wrapped up on the financial side of things, which is good, right? Making sure that they're saving, making sure that they are, putting away for later in life. And they become so accustomed to working that they haven't really thought about, well, what is it that they want to do if they're not working each and every day? And so maybe I'll just, push people to go back and re-listen to that one or listen to it if they haven't yet, episode 15. And that was all about what is your money for. And like you said, I think if you've saved up, plus you've, put a purpose to what you want to do with your life, then it can create a really wonderful life.
Yeah, very rewarding and a great experience. That's the goal. Something to live on, enough to live on, and enough to live for. So that's to get us some inspiration into today's conversation. And it's all about tax planning. It's all about some end-of-year strategies to be considering and to put on your radar and to be having these conversations with your advisor to help reduce how much of your income and your hard-earned savings and reduce that tax burden for this year and for the long term. I think that's the biggest thing, is looking out beyond just what's happening this year. So I think, Scott, the first place to start is defining tax planning. What exactly do you mean by tax planning? So we're all familiar, I think, with tax preparation, but what's planning?
Yeah, so tax planning, and I'll call it year-end tax planning and tax strategies, is taking a look at a person's situation and providing recommendations and doing whatever they should be doing to help put themselves in the best position possible by the end of the year. And when I say doing these activities, the activities I'm really talking about are, activities around their taxes. And this could be where they are contributing their money to. It might be where their money currently is and repositioning it between tax buckets. But it's a process where it's not really only focused on today, but it's looking at the rest of their life, right? So how much income are they bringing in today versus how much income will they have coming in the future? Where are tax rates today? Where do they believe tax rates might be in the future? And then putting together that all together around a strategy of where their money should be contributed to. And you might say, well, but hey, it's the end of the year. There's still changes that could be made before December 31st. And then it's also putting them in the right, having the right steps as they move forward into the next year. And a lot of people might be sitting there thinking, but wait a second, this is what I have a tax preparer for. And there's a lot of great tax preparers out there. However, tax preparers are like historians, where they're just looking at the past and saying, okay, this is, how much you've had come in income, maybe dividends, interest, and here's what you owe the IRS. And, sometimes we have these expectations that they'll be giving us tax planning advice. However, if they don't have access to all of your IRAs and 401ks, all of the money that you've saved up in brokerage accounts, maybe where you're, you've got other income coming in, or maybe you've got a potential inheritance coming in, without having that view of your total picture, it's really tough for them to give you tax planning guidance and advice. And so being able to see a client's total picture, we're able to not only look at today, but look at the future and do, help guide them and provide them advice to, again, put them in the best position possible to keep more of their hard-earned savings with them versus giving it to the IRS.
So we're talking about these year-end tax planning strategies now in October, the start of the fourth quarter, because you want to have that time to sit down and actually go through these things and not put off until December. It's always, as with everything, especially in financial planning, it's always better to get ahead and do things earlier on. So I know you've broken down these strategies into some different categories, right?
Yeah, so we've got, let's say, about, I think, 7 different categories actually 8 different categories that we're going to talk about today. Mm-hmm. And today I just want to keep it, I'll call it more top level. So it's thoughts that people can, hear about and go, okay, do I need to look into that strategy into a little more depth? And then over our, I'll say, next few shows throughout this month, what I'd like to do is take some of these strategies that I think are used most often, and what we'll do is we'll just break those down into further detail. So hopefully today we can cover it from just a top level standpoint, so people know the different thoughts and ideas that they should be thinking about before the end of the year.
Very good. So again, make sure you subscribe on the podcast, so as we release these extra episodes with really more detail on these tax planning strategies, you won't miss a single one. So let's go through these categories again, all kind of high level here on today's episode of Your Life, Your Money. And let's start off with the first one you have on your list, which is maximizing your retirement accounts.
Absolutely. So if you have the ability to contribute more, now's a great time to, maybe I'll say, up the percentage of what you're contributing to your retirement accounts, or making sure that you're set up to contribute to your retirement accounts, meaning putting away as much as you possibly can to help save for your retirement in your future. And this could be a 401k, this could be your Roth 401k, be an IRA, your 403b, 457s, maybe a IRA. If you own your own company, this could be a SEP IRA, simple IRA, or maybe like a solo 401k or solo Roth 401k. Some of these you're going to get by putting money in, some of these you'll get a tax reduction today. So again, for your picture, if it makes most sense to do tax reductions today based on your income, then some of these you'll get that tax reduction today, but remember, you will pay tax in the future. On utilizing some of these accounts, like the Roth accounts, you'll pay tax today. However, that will create a tax-free future for you. The other thing to really consider here, and why it says maximizing retirement accounts, is if you do have that ability to put in the max each and every year, you have to be really well aware that your company isn't going to, they typically don't say, hey, hey, Ben, you're $1,000 short. You could have contributed $1,000 more. It's
Right.
really, you are the owner of that situation. So if you want to make sure that you want to maximize your, how much you can contribute to your 401k each and every year, you're going to have to start talking to your HR department to say, okay, let's up, maybe we need to take a little bit more from this check or from your last check. Because here's the deal, they just don't want you to go over, because that creates a headache of having to cut checks back. And it's just not something that they're wanting to go through. So a lot of times if you're contributing, they might make you contribute less, but then you as the employee have to kind of work at the end of the year to make sure that you are getting that I'll call it that full maximum amount in. The other thing, for those that might have a non-working spouse, you can also make contributions. Again, this is all dependent on how much income you have coming in, but you can make a contribution to potentially either an IRA or a Roth IRA in the name of the non-working spouse. So another good way to think about how to take, income that you have coming in, not only saving it for your future, but using strategies. Maybe you've got money just sitting in a savings account that interest is generating taxes for you each and every year. And just by moving that to a Roth IRA, now it's taking that interest that's generating taxes and it's just made it all tax-free. And so it's just really looking at your situation, maximizing all the different, not only maximizing all the different accounts that you have access to, but maybe there's also ways that if you're a saver and you've got money just kind of sitting there as lazy money in savings accounts, how can you get that into a tax-free bucket based on your situation?
I got you. Well, when you talk about accounts too, one that it doesn't really come to mind automatically when I think about tax planning that you have on the list here is number 2 is your health savings account. How does that play into it?
So the health savings account, some companies offer these health savings accounts, also known as the HSA, for high deductible health plans. And this is actually a really, really great account. And I call it the triple tax advantaged account. Now, a lot of times people look at this and go, yeah, I just, I put money into it and then I've got health or medical expenses that come up and then I take it out. But if you really understand the advantages of this account, you'll understand not only the benefits for today, but how you could look at it and consider it its own retirement account. And here's why. As you put money in, you get a tax deduction. The money grows tax-free, and as long as you utilize it for qualified medical expenses, you can withdraw the money tax-free as well. So a lot of people like the Roth, right, Ben? Because they're like, hey, the Roth, boy, it grows tax-free and I make withdrawals tax-free.
Yeah.
It's almost like this is like a Roth for qualified medical expenses, but on the Roth, you pay taxes up front. So you did pay tax on that money, just pay taxes, you put it in the bucket. On the HSA, you actually get a tax deduction when you put the money in the bucket. So if you properly use the HSA, you've totally avoided taxes on all of this money. And here's the bonus here. The bonus is that you can invest this account. And so if you really think about this account from a long-term standpoint, you invest this money, and now you've got this money growing for you tax-free, that when you get to retirement, you could use it, again, qualified medical expenses like Medicare, long-term care, doctor's bills, to, maybe pay for any medicines that you use. So and plus many, many more. That was just, off the list that would, maybe connect with people of what they, typically think about as health expenses in retirement. So definitely an advantaged account to look at and use for retirement, and to think about, okay, at the end of the year, have you maximized how much you can put in to the HSA? Or if you're changing jobs, or, you've maybe haven't used the HSA in the past, maybe it's something that as you go through the open enrollment period, you make those changes for future years.
Yeah, that's good information. I don't know that anybody would think about the investing side of that money as well. So some opportunities there in a health savings account that maybe you haven't thought about yet. You touched on Roths too there for a second. So I know that Roth conversions is something that always comes up when you're thinking about year-end tax planning. I know I've heard this a number of times from advisors, but this is something that needs to be on your list to at least explore, right?
I believe so. And I think this is, a good thing to explore at the end of each year. And the reason being is because you'll have a better idea of where you're going to fall from an income standpoint before that, December 31st cutoff. And Roth conversions do have a December 31st cutoff. And first off, just, from a high level, what is Roth conversions? Well, you're converting some of your tax deferred money, that could be IRAs, 401ks, 403bs, to the tax-free bucket, or that Roth bucket. Now remember, as you move it from bucket to bucket, you do need to pay tax on that money. Now, why would you do that? Well, if you feel that your tax rates today would be lower than where they're going to be at in the future, then you might be saving yourself some, long-term tax money, long-term tax burden. So that's, there's two questions that really you want to ask yourself. What do you feel like your income will be in the future versus where it will be today? And where do you feel your tax rates will be in the future versus where they're at today? And a couple things to really note on this one, because I think people just, sometimes go, well, I'll be in retirement, income will be lower. Don't forget about your required minimum distributions. Work with a lot of clients that have saved up a fairly healthy amount. And next thing you know, those required minimum distributions, maybe not right away, but in your 80s, those required minimum distributions could maybe put you at a similar amount of income than where you're at today, or even higher. Another thing to think about is that if you're a couple, if one spouse were to pass away, the remaining spouse most likely will be in a higher tax bracket. If you look and just compare for, I'll call it equivalent income from a single to a couple, the single and the couple are making the exact same amount of income. The single's most likely going to be getting taxed at a higher rate than that couple. So leaving your spouse, right, with these IRAs and 401ks and 403bs could actually kind of be leaving your spouse in a potential tax trap, meaning they need more money to live and the government's taxing them more at the same time. So it's just a strategy that you want to look at. The process that we go through with our clients is to first forecast where their income is going to fall by the end of the year. We go through those two questions that I mentioned earlier, and then we look at converting, again, maybe not all of it, we look at converting portions of it up to certain tax brackets, but then trying not to go over those tax brackets, right? So it's a very strategic approach when it comes to Roth conversions.
Yeah, very strategic, and it's one that, as Scott mentioned, you should be thinking about every single year. It takes us to our next one in terms of taxes as you're looking through that and figuring things out. I've heard the term tax loss harvesting. You got tax gain harvesting on here as well. Explain those to me.
And these are approaches that you want to look at when it comes to your non-retirement accounts. So as you know, in the IRAs and the Roth IRAs, all the taxes, right? One's growing tax deferred, one's growing tax free. So the tax loss and tax gain harvesting is in those non-retirement accounts, also a lot of times called those brokerage accounts. And these accounts, right, each and every year, they might push off interest or dividends. But the other thing to think about and consider is that if you've just been holding funds or stocks in these accounts, those funds or stocks could have losses or could have gains associated with them that have, I'll say, are deferred, but are deferred until you make those buys and sells. And so looking at these accounts at the end of the year is a good thing to do, because you might have some investments with losses and you didn't plan to just keep those investments around anyways. And so by recognizing those losses, by selling those investments, you can take some of those losses and use them to offset income that you have coming in, or offset gains that you have in other investments. So it's kind of a way to help reduce your taxes, reduce other income that you have coming in. And the reason why I say take some, you actually do get to recognize all of those losses. Again, it just depends on your taxes, but sometimes depending on other gains that you have coming in, you might be able to recognize all those losses, or you might have to carry over some of those losses to future years. We can go into some more depth in that on another podcast. But the other thing to look at is gains. And why do I talk about that? Well, it might be a good time to recognize gains that you have on some of your different funds. And you could sell the fund, recognize the gain, and then you could just repurchase that same fund, or maybe you decided to diversify and go somewhere else. And why would you want to look at doing that? Well, maybe you're in a year where you've got a very low income or no income, right? You've structured things, you've put together the right strategy where you've really lowered your income for a few years. This is a way to sell. And if you've held on to these stocks or funds for more than 1 year, you could be looking at long-term gains, and long-term gains are at a more favorable rate than short-term gains, are at a more favorable rate than your income tax rate. So it's a way to sell, and maybe you could recognize these at 0% or maybe at 15%. Again, it's typically a more favorable rate than your income rate. And by doing that, you're now increasing your cost basis. So by doing it at a lower, at a point where maybe your income's lower, or you know that you'll be able to recognize the gains at a more favorable rate, you've now increased your cost basis, meaning the value that you own that you wouldn't be taxed on in the future. So it's just some strategies to look at, and again, you're looking at it not only for your tax picture today, but where you might be at in the future.
The next one on our list is withholding, and I think about I've had to do this personally myself as we got later in the year. Just kind of look at your withholding to see if it makes sense. Maybe you should adjust. Is that something, as you doing this withholding review? Is that something you can adjust for that year? Or is it more looking forward to the next year?
Well, a couple different parts, Ben. And let me just ask you, how do you like financial surprises?
I don't enjoy them. Well, unless I guess it's like a lottery or inheritance maybe, but I don't like the ones that say, hey, you owe this much money now.
Right. And I've found the same thing. Not a whole lot of people like those financial surprises where the IRS puts out their hand and says, hey, you owe me X amount of dollars in taxes.
Right.
And so part of our process, year-end process, is doing a tax projection for the current year and looking at that and then comparing to how much our clients have withheld from a tax standpoint to make sure that they've withheld enough, because sometimes if you haven't withheld enough, then you would have to pay the IRS an underpayment penalty. So you want to make sure that you're avoiding any sort of underpayment penalties. The other thing, and that's why I asked about the surprises, I'll tell you a quick story. I have a client that through the year, their income increased, but they also were given some very large bonuses. And it's just natural to think that your company is handling things, your company's taking care of things, your company's withholding for taxes. But based on the bonuses that they got, it actually put them up into a whole new tax level and tax bracket. And so when we did the year-end forecast, what we found is that the company was not withholding enough and that they were going to owe thousands of dollars more to the IRS. So while it was still a surprise, it was better to be a known surprise in October versus an unknown surprise and not being planned for in April. And so that's a big thing to look at as well. I think people don't realize bonuses, income, and that like mutual funds or funds that they own could have been pushing off dividends and interest. And so it's all just trying to help avoid any of those unknown surprises.
Yeah, nobody likes the unknown surprises, no question. All right, a few more on our list for this tax planning items end of year. Educational planning. This is an interesting one. This is not one that I would immediately think of at all when it comes to tax planning.
Yeah. And the reason I brought this one up here, and this one's actually a pretty simple one. If you have, let's say, children or grandchildren that are in college or that are going to be going to college in the future and you want to help provide support to them, you may want to contribute to a 529 plan. And why that becomes a tax planning item is some states, not all, some states actually allow you from a state income tax standpoint to take a deduction for what you contributed to their 529 plan. So I look at this in a couple ways. You might be able to get that tax deduction for contributing to the 529 plan, plus if you've got, let's say, funds sitting in a brokerage account or savings account, and you plan to help your children or your grandchildren. Anyways, this is a way to get that money out of your taxable income, right? Because it might be generating dividends and interest, which adds to your taxes. So it takes this money out of your taxable income. And then by putting it into the 529 plan, you're going to help the person anyways, gets it out of your taxable income and puts it into an account where it's going to grow tax deferred, and if used properly, can be used, the gains can then be used tax free.
Right. Okay. That's a good one. Good one to note. All right. I know end of year, a lot of people are thinking about the charitable giving aspect of things and working that into their tax planning as well. I know now is a good time to be thinking about that, right?
Yeah. And let me talk about two of the, I'll say top ones to maybe be considering.
Okay.
If you're donating to charities and, you might be looking at it going, boy, I've given a lot to charities in the past, but now, because of this standard deduction, the higher standard deduction, I'm no longer able to take the tax deduction. One of the things that you can look at, and it all depends on how much you typically give to charities and where your money is positioned today. But from a top level, one of the things that you can look at is a donor-advised fund, which is putting money into a fund that will go to charities, but you don't have to use it all in one year. You can give it to those charities over time. And that could allow you to take the tax deduction today, right? Versus, so now because you're putting that money into that fund and it might be larger than your standard deduction. So now you're getting the benefit of not only giving to the charity, but you're also getting the tax benefit of being able to deduct the money that goes into that fund. Again, it all depends on the amounts and where your money is sitting today. The other one, the second one to really think about here is if you are over the age of 72 or if you're taking your required minimum distributions, you may want to consider the qualified charitable distributions, which is taking what would otherwise be your RMD and giving, and it can be, again, all or a portion, right, directly to the charity. So instead of taking your required minimum distribution, you're going to give whatever portion you so choose directly to the charity. And by doing that reduces the taxable income that you have coming out or that you have to claim as income on your taxes. So let me just give an example of if your required minimum distribution was $50,000 and you took all of that, you're going to have to add $50,000 into your federal income taxes. However, if you gave $5,000 directly to a charity, well, now instead of claiming all $50,000 on your income taxes, you only claim $45,000. So it's a great way to reduce your income in addition to taking that standard deduction.
Yeah, definitely so many things to be thinking about. And we got one more to put on the list before we close it out. Legacy planning. How does legacy planning fit into this conversation right now?
So legacy planning is one that people might not really have been thinking about. But, I work with a lot of clients where they're saving. And at the end of the day, they recognize that they're not going to use all of this money. And part of the thing for them is that it was important to them to pass on a legacy or pass on an estate to their children, to their family, to their beneficiaries, whomever they so choose. And so the reason why this comes up is each and every year you have the ability to gift $15,000 per donor per recipient. So let's just say you have two children. One spouse could gift, right, $15,000 to each child. That's $30,000 total. And each parent, if they so choose, could do that. And one of the reasons that you would maybe want to look at this is getting these funds, this money, out of your taxable estate. Maybe you're on the border of going over the thresholds of the federal or state estate tax limits. So by getting this money out of your estate, it helps reduce where you're at and keeps you under those estate tax limits. The other thing is maybe just if this was part of your long-term plan, right, that, hey, some of your money, yes, was going to go to your children. Let's just say your children are in a lower tax bracket than you. Again, getting this money out of your taxable estate and into your children's, tax picture helps keep more of this money in now your family's pocket, right? Because if your children are a lower tax bracket than you, it helps keep this money more now in your family's pocket versus giving it to the IRS. So a lot of this is looking at what you could call as like family tax bracket management.
Right. That makes sense. Well, there's a lot, Scott. I mean, you've laid it out, and again, kind of taking a high level approach on everything, right? You're going to get into more detail on these items individually in upcoming podcasts. So I recommend anybody that is curious about this or wants to learn more, first subscribe. You can also log on lifemoneyshow.com, and then also Scott's number to talk directly about tax planning is 847-235-6989. But as you laid out this list, I mean, I can kind of see why this is something you should start getting into and discussing in October or even November, but waiting till December to go through this entire list and do it thoroughly seems like it would be nearly impossible.
Yeah, there's a large list here, and there's a lot of, we just really scratched the surface today, tried to help give as much beneficial information as we could, but there's a lot of detail to each and one of these items, and it takes time to go through and put together the year-end forecast, not only of your income that you'd have coming in, but where all of your money sits today, dividends, interest, everything that that will add up into that tax forecast. And that's why I highly recommend that people sit down with not only an advisor, but your tax person, tax consultant would need to get involved as well to make sure that, you're putting yourself in the best position possible.
Absolutely. Well, thanks for taking us through this, Scott. Again, lifemoneyshow.com is the website. Please subscribe, whatever podcasting app you listen on. Also, hit up Scott's YouTube channel as well. You can subscribe there to that and get the latest. But we keep everything right there in one central location at lifemoneyshow.com. Thanks for taking the time today, Scott. I look forward to finishing out this 2021 on a high note, and it all kind of starts with tax planning.
Thanks, Ben. Look forward to another great conversation.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.